Breaking news, car enthusiasts and savvy shoppers, Stellantis just dropped a bombshell that's shaking the automotive world to its core. Ram, Dodge, and Chrysler are slashing prices by a jaw-dropping 35% off MSRP. You heard that right. The entire car market just got turned on its head. But what's behind this shocking move, and how does it affect you? Hey there, gearheads, welcome back to the channel, where we bring you the latest and greatest in the automotive world. Today, we're diving into this massive news. But before we get started, let me ask you, would a 35% price cut finally put your dream car within reach? Let me know in the comments. So why is Stellantis, one of the world's largest car manufacturers, making such a bold move? Let's break it down. The competitive edge. With EV startups and traditional brands like Tesla and Ford waging an all-out price war, Stellantis is firing back with a strategy no one saw coming. But here's the kicker. This isn't just about staying competitive. It's about dominating the market. Overstocked inventory. The post-pandemic car production boom left many dealerships with excess stock. This price cut? It might be their way of clearing out inventory fast. But is it sustainable? Future-proofing against EV domination, Stellantis has big EV plans for the coming years, and slashing prices on current gas-powered models could be their way of making room for what's next. Do you think this signals the end of traditional gas-powered cars? Imagine driving this beast of a truck, a Ram 1500, for 35% less than MSRP. That's thousands of dollars saved. Or how about a Dodge Challenger, roaring down the street, finally fitting your budget? Does this change how you'd shop for a car? And let's not forget family-friendly options like the Chrysler Pacifica. What would a lower price mean for families needing reliable transportation? Could this move make Stellantis the top pick for the everyday driver? Here's the big question. Is this price cut the deal of the decade? Or is it just a desperate move in a brutal market? And most importantly, are you ready to take advantage of it? Let's start with the sheer scale of this discount. A Ram 1500 that typically starts at $50,000 now comes in at just $32,500. A Dodge Charger priced at $42,000 drops to around $27,300. And a family-friendly Chrysler Pacifica, usually $38,000, now sells for just under $25,000. These numbers are game-changing, especially for consumers who've been priced out of the market due to inflation and rising interest rates. These cuts aren't limited to base models either. Higher trims and feature-rich configurations are also eligible, though inventory availability will be a key factor. But why is Stellantis making such an aggressive move? The automotive industry has been grappling with several challenges. Economic pressures, like inflation and rising interest rates, have made financing a vehicle less attractive to many buyers. As a result, dealerships are sitting on excess inventory, particularly for gas-powered vehicles, as the shift toward electric cars accelerates. By offering significant discounts, Stellantis is clearing out older stock while keeping its factories running and dealers engaged. Another critical reason for this price cut is competition. Tesla has been slashing prices on its electric vehicles throughout 2023 and 2024, and Ford followed suit with similar reductions on its Mustang Mach-E and F-150 Lightning. Stellantis had to act to stay relevant, especially with its ambitious plans to dominate the EV market in the coming years. With over 75 electric models planned by 2030, Stellantis is positioning itself to lead the transition to a more sustainable automotive future. For the average buyer, this price drop presents an incredible opportunity. The discount makes previously unaffordable vehicles accessible, and for many, it could be the difference between settling for a used car or driving away in a brand new truck or SUV. However, there are critical considerations to keep in mind. Lower prices today could impact the resale value of these vehicles in the future. If new cars are cheaper, used car prices may plummet, reducing the trade-in value of your current vehicle. Additionally, dealerships might attempt to recoup their losses through hidden fees, mandatory add-ons, or less favorable financing terms. Beyond the immediate savings, Stellantis' move raises questions about the broader industry. Will other automakers follow suit? If Ford, GM, Toyota, and Honda feel the heat, we could see a cascade of price reductions across the market. This could spark a competitive frenzy, making 2025 one of the best years for car buyers in recent memory. On the flip side, what does this mean for automakers' profitability and their ability to invest in future technologies? Stellantis is also playing the long game. By clearing out gas-powered inventory now, the company is setting the stage for its upcoming electric vehicles. The Ram 1500 REV, their first all-electric truck, is poised to challenge the Ford F-150 Lightning and Tesla's Cybertruck. Similarly, the Dodge Charger Daytona EV promises to bring the thrill of muscle cars into the electric era. These models signal Stellantis' intent to dominate not just today's market, but tomorrow's as well. For buyers, this creates a dilemma. Do you take advantage of these massive discounts on traditional gas-powered vehicles now, or do you hold out for Stellantis' cutting-edge EVs? Gas vehicles, while cheaper upfront, may come with higher long-term costs for fuel and maintenance. On the other hand, EVs offer lower operating costs and future-proof your investment, but they come with a higher initial price tag and questions about charging infrastructure. Dealerships have already reported a surge in traffic since the announcement, with many buyers flocking to take advantage of the deals. However, the most popular models and trims are selling out quickly, leaving less desirable options for latecomers. If you're considering a purchase, acting fast while doing thorough research is crucial. Know the MSRP, calculate the 35% discount, and ensure you're not being upsold on unnecessary extras. The ripple effects of Stellantis' decision extend beyond its own lineup. Competitors are closely watching how the market responds. If this strategy pays off, it could force the entire industry to adapt, making 2025 a landmark year for affordability in the automotive sector. This could be the beginning of a price war that benefits consumers, but challenges automakers to rethink their strategies. As this story unfolds, the big question remains: how will buyers and competitors respond? Will this discount push Stellantis to the forefront of the market, or will it trigger unforeseen consequences for the industry? For now, one thing is clear: this is a pivotal moment in automotive history, and whether you're a car enthusiast or a casual observer, it's worth paying attention to. Stellantis' financial condition plays a pivotal role in understanding the broader implications of their 35% MSRP cut across their vehicle lineup. To get a better grasp of the company's financial health, it's essential to take a look at their recent performance, strategy, and market positioning. Stellantis' financial performance in recent years. In 2023, Stellantis reported strong earnings facing the global automotive market. The company's global net revenues reached approximately $179 billion, with an operating income of around $16 billion, reflecting a solid profit margin of nearly 9%. This strong financial standing has allowed Stellantis to reinvest in its business, particularly in electrification and technology, which is a cornerstone of its long-term strategy. Stellantis is a massive entity, born from the merger of Fiat Chrysler Automobiles, FCA, and PSA Group in 2021, and it boasts a portfolio of well-known brands, including Dodge, Ram, Jeep, Peugeot, and Citroën, among others. The combined strength of these brands gives Stellantis a robust financial foundation. Despite facing challenges, such as rising raw material costs and supply chain disruptions, Stellantis has managed to maintain its profitability through a combination of cost-cutting measures, vehicle price increases, and improved production efficiency. However, the auto industry is changing rapidly, especially with the rise of electric vehicles, and Stellantis has invested heavily in transitioning to an electrified future. Strategic focus on electrification and cost management. One of Stellantis' core strategies to stay competitive is its push into electrification. The company is committed to launching 75 new electric models by 2030 and achieving carbon neutrality by 2050. Stellantis has already launched the all-electric Fiat 500e and the Jeep Grand Cherokee 4X, with more EVs slated for release in the coming years. This transition is part of their broader strategy to capture market share in the growing electric vehicle sector, and this long-term focus is driving significant investments in R&D and manufacturing infrastructure. However, Stellantis faces the challenge of balancing these massive investments in EV development with the ongoing demand for traditional internal combustion engine. The company's ability to manage this transition effectively will be crucial for its financial stability in the years to come. The 35% price cut could be seen as a strategic move to liquidate some of the existing inventory before fully committing to EV production, ensuring they maintain sales momentum without compromising their position in the market. Cash flow and liquidity. Stellantis' strong financial performance is also evident in its cash flow and liquidity. In recent years, Stellantis has been able to generate substantial free cash flow, which is critical in funding its electrification initiatives, R&D efforts, and acquisitions. In 2023, Stellantis reported a free cash flow of $5.3 billion, a number that demonstrates the company's ability to manage its operations efficiently while continuing to reinvest in future technologies. Their liquidity position is also robust, with $27 billion in cash and cash equivalents at the end of 2023. This ample cash reserve provides Stellantis with the financial flexibility to weather economic downturns, invest in new technologies, and manage any unforeseen disruptions in the market. However, with rising inflation, supply chain volatility, and the transition to EVs, Stellantis will need to carefully navigate its financial resources to stay ahead of the curve. Profitability and market position. Stellantis has consistently posted healthy profit margins, reflecting a strong operating model. However, as the automotive industry shifts toward more sustainable practices, profit margins for traditional ICE vehicles are expected to shrink in the long term due to stricter emissions regulations, rising production costs for EVs, and the ongoing semiconductor shortage. Stellantis is well aware of these trends and has adjusted its business strategy accordingly. While the company's overall profitability remains strong, its focus on EVs and sustainability is essential for securing long-term growth. Additionally, Stellantis has a dominant presence in key markets such as North America and Europe. In North America, the company's Ram and Jeep brands are among the most profitable in its portfolio, thanks to their strong sales and loyal customer base. The aggressive price cuts on models like the Ram 1500 could be a way to both attract new customers and retain existing ones, boosting short-term sales and preventing market share losses to competitors like Ford, GM, and Toyota.